You must have heard about various ratios, rates that has to be calculated in order to get into the market. You must have heard about various ratios and the calculations, how they are done. But however, it makes a very big difference if you get into the balance sheet and actually start analyzing which figures are to be taken in order to calculate such ratios and rates and how you need to analyze them. In this video, we'll not only be looking into the formulas of ratios, the rates, but we'll be actually getting into the profit and loss account, understanding what it comprises of. We'll be looking into the figures, we'll be getting into the balance sheet, we'll be understanding what comes under a balance sheet, and then we'll be together calculating the ratios, the rates, and thus we'll be well versed in doing so, and successfully we can invest in shares of company. In order to read the balance sheet of the company, I need to know about the company. So I've just taken for example, a company listed on stock exchange. So where I'll get the balance sheet? I'll go into investor relations. I'll go into annual reports. And here I'll take the latest annual report. So it will take some time. Since it's a big report. So if you go to see the contents, it will include from the managing director's desk, that will talk about the views and insights of the managing director, the financial highlights of the company, the director's report, where the director will talk about the financial performance, which will include revenues, profits, non-financial performance, that will talk about the market share increase, new developments, innovations. Management discussion and analysis will include this discussion about the general environment in which the company is functioning, the consumer behavior, opportunities, threats, risk concerns, market environment, etc. Business responsibility report, the basic elements of the company, the performance, the processes undertaken by the company. Corporate governance report, that what the company is giving back to the society. The auditor's report, that will talk about whether the auditor has given a clean report or is there any problem. Balance sheet, statement of profit and loss, cash flow, the notes forming a part of the financial statements, company information and policies. Interest coverage ratio is a ratio that determines how easily a company can pay off its debt expense with earnings. It is also called times interest earned. It indicates how many times a company can pay off its debt expense using the available earnings. It measures the margin of safety for the company during the tenure of payment of interest. This ability of the company is very important in order to know the future solvency of the company, and it's a very important ratio for the current as well as future investors. If the company struggles with this ratio, it has to take either further debt or utilize its cash reserves, which could have been otherwise utilized to grow and expand business. If the ratio is below 1, that means the revenue is not enough to cover the debt expense. It can result in bankruptcy. A right proportion of debt is anyways desirable, but however, the company has to be smart enough to handle the loan and timely pay off the debt as well as the interest. Debt interest coverage ratio can be calculated by dividing earnings before interest and tax by interest. So we'll be calculating interest coverage ratio. For interest coverage ratio, we need to know the earnings before interest and tax, and we need to know the interest amount. Now here, earnings, that is profit before exceptional items, is 1,50,900. This is before tax and this is before exceptional item. However, it is also taking into account the finance cost which we need to add back. Now, I also do not take exceptional item because these items are unusual and they do not occur on a regular basis. So, for earnings before interest and tax, I take 1,50,900 and I add to this the interest cost, that is 36,000. The total being 1,51,900. Now I take the finance cost as, that is the interest cost as 36,000, and the ratio, the coverage ratio being 4.2, that is around almost 4 times the earnings can cover interest. Now, when investing, you need to know whether you are investing in a large cap or small cap or mid cap. Now, these caps are nothing but market capitalization. Market capitalization is defined as market price into number of shares. Now, a large cap, a small cap is based on various parameters. Above a particular amount of market capitalization, the company becomes a large cap. Below that, it is a mid cap or a small cap. Depends. This capitalization, whether it's a large or small, depends upon the market in which you are investing. Now, how they are defined depends upon a particular sector or a particular market. Getting into calculating the market share, I get into a balance annual report where I get into the balance sheet of the company, and so this is the balance sheet where under shareholders fund I see share capital, and it gives me an amount and it tells me the note under which I can find the breakup of the amount. Now, these notes refer to what the amount comprises of. Now, under note 1, I'll get the breakup of this share capital. So, I'll see the note here under note 1, share capital. I can see authorized share capital and I can see the issued, subscribed and fully paid up. This is the number of shares which is actually in the market, which has been issued, subscribed and fully paid. So I take this figure so the number of share, and in order to know the market price, I go to the website and I can see the market price which is at which the share is trading at present. And I can calculate the market capitalization of this company, and depending on the parameter, you can classify this as a large cap or a mid cap. I can just show you the figure. Price to earnings ratio. It's a very important ratio. It calculates or it measures the value of a company by dividing the market value, market price per share, by the earnings per share. It indicates how much an investor is willing to invest in a company. For example, how much dollar investor is willing to invest in a company to get $1 from that company. It indicates what you are investing against what you're getting. For example, if the price earning is 10, that means an investor is willing to invest $10 in order to get $1 earning from that company. A high PE indicates that the investors are expecting high earnings from the company in future, whereas a low PE means a company is currently undervalued or doing very well. Now let's calculate price to earnings ratio. In order to calculate price to earning ratio, we need to know the market price of the share and we need to know the earnings per share. Here, the earnings per share for the latest year I can see as 7.89. So when I calculate price earnings ratio, I take the market price from that's the market price. Currently the share is trading at what price I can take from any website. I've taken from, say, Money Control. The earnings per share I take as the latest earnings per share 7.89 and the PE ratio that I've calculated is 7.6. There are various risks that affects your share price, not just the performance of the company. Market risk, business risk, credit risk, taxability risk, interest rate risk, inflation risk, liquidity risk, and risk which is connected to that economy. Market risk, which is the systematic risk. You must have seen when the markets are doing very well, all the shares in general are performing well and vice versa. So this is a kind of systematic risk because if your Sensex or the market index is moving upward, all shares are moving upwards until and unless there's some problem with that company, the share price is falling. When the markets are going down, you'll see a tendency of majority of shares, the prices of the shares to fall until and unless the company is really doing that well, that can withstand all this pressure. Business risk. Now business risk is, it depends upon the company to company. If the company and the sector in which the company is performing is not doing that well. For example, if a particular metal is not doing that well and if the company is operating using that metal, then there might be chances that the company's share price may fall. That's because in general the company is not doing well. The company is not performing in the environment it should perform. The environment is not conducive. The policies are not good. It's going against the company and various other reasons which is affecting the company as a whole. It may not be same for the other companies. Credit risk. If the company is doing very well, may be able to borrow credit or loan from the market. However, if the company is having lot of debt and is not able to pay the current debt, there may be chances that company may not get more money to pump in. And if the company is lacking liquidity, it will not be able to expand its business and help the company to perform well. In that case, the company's share price may fall. Taxability risk. If the company, say, is performing very well in a particular area and suddenly there's a government policy that a particular tax is levied on the products, that company's product price may rise, as a result of which it may be demanded less by the public, or it may be that the income tax of the public may be increased, say from 10% to 15%. So they'll have less disposable income to spend on the product. Where such situation arises, it results in taxability risk. Interest rate risk. See, in a particular economy, the government has raised the interest rate. So now the fixed deposits are looking very favorable, the bonds are looking very favorable. So at such time, people will not invest in market, they will go to banks and invest. Say they will buy fixed deposit, they will pull out money from the stock market and invest in banks. In such situation, the price of the shares tend to fall and vice versa when the interest rate will reduce. Inflation risk, where the economy in general is under inflationary pressures. The prices of goods and commodities will rise. So, people will not have that disposable income to spend in shares. So, the economy in general will not perform, and where a share price is, the company is depending on the economy, the prices of the shares will fall and vice versa. Vice versa in the sense where the economy is doing very well. People are having a lot of disposable income. The price of the products are going very high. The company where it's depending on the economy and the products are doing very well, the company is doing very well, the profit is increasing, the prices of the shares will go up. Liquidity risk. Liquidity risk is where a company it's not performing that well, not having money to pay debt. So it may result in liquidity risk where bankruptcy proceedings will be initiated by the creditors. Risk related to economy. It can be socio-political risk, various other risks. For example, the political situation is not very well. The government is not very friendly with the policies of the industries. At such time, the industries suffer. A lot of taxes that are levied in industry, or probably maybe they are not. The government does not allow free trade policy. At such time, the economy as a whole suffers. With the industry, the products of the company may not perform that well in the market, and as a result of which the company falls, and the share price of that company also falls, affecting the market as a whole. Going about reading a balance sheet. The financial statements consist of the balance sheet, income statement, cash flow, equity. Now, the income statement, it includes profit and loss of the company that the company has made in the current year. Whereas the balance sheet talks about the strength and weakness of the company. The balance sheet includes assets, equity, liabilities. Assets are the future benefits that will accrue to the company. It includes all the items owned by the company. For example, property, plant, equipment owned by the company. The company can make use of this property, plant, equipment to produce goods that the company can sell and gain in the long run. Whereas liabilities are obligations of the company. Now this obligation can be current or non-current. Equity. Equity consists of the owner's capital, which means the net accounting value of the company.